Hey everybody, this is Halstead and Andrew McMillan with REH CPAs. Today we want to talk about some of the common mistakes we see when people convert to an S corporation. I've got Andrew McMillan here with me. Andrew, what are some of the common mistakes that we see when people convert to an S corporation?
Well, first off, you got to understand what the requirements are of an S corporation to be an S corporation. And one of them is you must be a domestic corporation. You must be based here in the U.S. To be eligible to be an S corp. You also have to have less than 100 shareholders. And the shareholders can only be like people, individuals, estates, and some trusts. So there are some limits on who can actually be an owner of the S corporation. All the owners must be U.S. residents, and the corporation must also only have one class of stock. So if you are not in line with those requirements of an S corporation, then by default you can't be an S corp. So understand that there are some limits there on who can be an S corporation.
Right.
Another common misconception we get a lot is a client thinks they're an S corporation just because they created an LLC, and that's just not correct. To actually be an S corporation, you have to take it one step further and file a form 2553 with the IRS. And if you want it, there are some time limits around when that needs to be filed to make sure it's effective when you want it to be effective. But you've got to make sure that you file that 2553 with the IRS.
And probably one of the biggest mistakes that we see is people think they're an S corporation because they think the 2553 was filed, but then we later find out that either they didn't file it or the IRS didn't receive it and didn't process it. And sometimes we don't find out until like 3 or 4 years down the road when the IRS finally sends a letter that says, hey, you keep filing these S corp tax returns, you're not an S corporation, and now we've got a big problem on our hands. So how do you guard against that?
So you want to make sure you get a letter from the IRS, because once you file that form 2553, typically within 60 days you're going to get a letter from the IRS saying, hey, we've received your S corp election and it's effective, January 1 of this year. So you want to make sure you get that letter and hang on to that letter, because that lets you know that the IRS has verified you that you are now an S corporation and you need to file S corp tax.
And it's so common. It's one of the first things we ask clients for when we bring them on board is their letter from the IRS accepting them as an S corporation. If they don't have it, a lot of times we call and make sure that they are.
Yeah, if you don't ever get the letter, you can call the IRS and verify.
And they'll send you another one too.
They will. So you want to make sure you got verification from the other end that you have filed the correct paperwork and they've received.
Awesome. So what's one of the other big things that we see whenever somebody is converting from, say, like an LLC partnership or a C corporation or even just a sole proprietorship LLC? What's one of the biggest things that we look out for?
Yeah, so if you're converting an existing business that you have to an S corporation now, it falls under a tax code, a 351 exchange. So at a high level, it's pretty simple because it just allows you to convert your business to an S corporation tax-free. There's no taxable event there.
That's the key. The 351 transfer is a tax-free transfer, and you have to qualify for it.
And you have to qualify for it. So there are a couple rules within the 351 exchange that you want to make sure you follow, like you've got to have ownership of the company and receipt of the stock. But the biggest one we see is if you're a business and you have liabilities within your business that are in excess of your of the tax basis in your assets. The most common example is you have a work truck in your business that you purchased at the dealership with a loan. So you bought a $50,000 work truck with a $50,000 loan. But for tax purposes, we've fully written off that truck to take a tax deduction. So your tax basis in that truck is now zero, but you've got a liability out here of $50,000 still. So in that type of situation, when you're upside down like that from a tax basis liability perspective, it can create a taxable event when you want to convert to an S corporation. So 351 exchanges to convert to an S corp are awesome. For most people, they work out really well for them to do that conversion tax-free, but you want to make sure that if you've got liabilities that you have a discussion with someone to make sure that that's managed properly so that you don't create an unnecessary taxable event here.
Awesome, because that's one of the first things we look at whenever we find out somebody's wanting to convert to an S corporation. And unfortunately, a lot of times it's after the fact. We get somebody who's converted and then we find out we have this 351 transfer problem. So very good information.
Yep, so a lot of small, closely held businesses, they want to be an S corporation, and at a high level, it's pretty straightforward, but there are some pitfalls within there that you can get tripped up on.
Yeah, so unfortunately, a lot of people, they do a lot of Google research to figure out how to become an S corporation, and they don't know all the nuances. So I would be very careful of making that decision on your own. If you have any questions on converting your business to an S corporation, please give us a call. We'll sit down and talk with you about it and figure out the best route for you. I appreciate it. Thanks.